Hey everyone, and welcome back to the channel. In today's video, I'm going to be explaining to you how you can use Phil Town's payback time method of valuation to value stocks and determine how much you should be willing to pay for them. I got a question from a subscriber who wanted me to cover the payback time method, which is what Phil Town teaches in his book and in some of his videos on YouTube. And I thought that this would be a very useful topic for a lot of people, so I decided to make an entire video on it. If you have a question or a problem or some kind of topic that you want me to discuss in a video, then make sure you leave it down in the comment section below. I read through all of your comments and I try to reply to as many as possible. And if you have a topic or a question that I think can be useful and applicable to many people, then I might even make a video on it. So please go ahead and leave a comment on what you want me to make videos on in the future. But let's just get straight into it and start by talking about what a payback time is. What does that mean? And essentially what we're talking about is how long does it take for an investment to pay us back our initial investment. So you could imagine that if you paid $100,000 for a business and that business generated $10,000 of profit every single year into infinity, then it would take you 10 years to get your money back. So that would be a payback time of 10. Because if you look at the cash flows, you would have an initial outflow, a cash outflow of $100,000. And then each year over that time, while you hold the business, there would be a cash inflow, a positive cash flow of $10,000 every year. So it would go $100,000 out, 10 in, 10 in, 10 in, 10 in, over and over again until the 10th year. And by the 10th year, those positive cash flows that you've received or that are the profits of the business are the exact same or have outweighed your initial outflow. And that is what we call the payback time. Now, it's very easy to calculate the payback time of a business when it has the exact same cash flows every single year. But what about if those cash flows are growing, which is the case for most of the businesses that we're looking to invest in? We're generally looking for businesses that are growing their cash flows somewhere between 10 or maybe even 15% per year. So then how do you calculate the payback time if the company is growing their profits? And really, there's no real reason you would need to do this manually. So the best thing you can do is use a calculator. Now, in the spreadsheet that I have linked down below, it's completely free. I actually have a payback time calculator. In that spreadsheet, you just enter in the latest cash flow, that's free cash flow, the latest free cash flow number that the company has produced, which is generally pretty close to how much cash is going to be returned to us as shareholders. And then what you do is you also enter in the growth rate of that cash in the future, and then you also enter in the market capitalization, which is essentially the price for the whole business. And this will tell us what the payback time is. Now, if you don't want to use my spreadsheet, that's completely fine. You can also use the payback time calculator on Phil Town's website. So he also has one, and you just enter in the first cash flow, you enter in the growth rate, and you enter in the price or the market cap, or whether that's per share, you can do either, and then it will tell you what the payback time is. So now that you know what the payback time is, what is a good payback time? What are you looking for? Because it doesn't really help you to just calculate that a business has a payback time of 11. Is that good or is that bad? Well, according to Phil Town, his rule of thumb is that you should look for a payback time of less than 8 years. So once you plug in those numbers, you're looking to pay a price that will ensure that you get a payback time of less than 8 years. And the reason that he says he chooses 8 years is because when it comes to private equity investments, when there's private investors just investing in a whole business, generally that is what they look for. They look for a payback time of less than 8 years. And what that actually equates to is an annual return of about 9% per year. So if you find a company and it has a payback time of 8 years and you buy that company and all of your assumptions, your assumptions about the growth of the company is accurate, you're going to probably make somewhere in the 9% per year range over the next 10 years, or at least over the next 80 years during that payback time. Now, 9% is a little bit of a low return for what I would would personally look for. I'm usually looking for about 15%. So what you can do is you can assume that at an 8 payback time, that could be the fair value or just undervalued, or sort of around an undervalued price. And then what you would do is you would want to pay a little bit less than that to allow for a margin of safety. And that could ensure that you're going to make something more substantial, like maybe a 15% return per year during that time. So do I personally use this method when I'm calculating the future or calculating the value, I should say, of a business? And really the short answer is no, I don't. While it is in my spreadsheet and I do use it sometimes to get to a quick valuation, I generally don't use it. I just stick to my valuation method, which is the very traditional way of valuing a company, which is by calculating its cash flows and discounting them to get the intrinsic value. So I use a discounted cash flow method. And essentially what that means is that instead of targeting a particular payback time, so instead of looking to get my money back within 8 years or within 4 years or within 12 years, I'm looking to get a specific return. And that's what the discounted cash flow allows you to do. It allows you to target a return, and the return that I generally target with a discounted cash flow is probably about 22% or sometimes even 26%. And what that means is, it means if I'm accurate in my predictions, I'm going to make between 8 and 10 times my money over the next 10 years. And if I'm completely wrong by 50%, then I'm going to still make about 15% per year, because 8 times your money is a 15% return with a 50% margin of safety to allow for errors in my valuation and for the fact that not all the companies are going to perform as we expect into the future. A lot of the time when I'm calculating the value of a company, what I'll find is that the payback time will give me a price that's about the fair value that I think a company is. So when I calculate intrinsic value with a discounted cash flow, I'll get about the same intrinsic value number as the payback time. However, I never pay the intrinsic value. I always pay at least 50% discounted from that intrinsic value number. So that would mean that if I was using the payback time method, I would be calculating what it is, what the price to pay would be at a payback time of about 4 to 5 years instead of 8 years. So that is substantially less than what Phil Town looks for. But that's just because I'm very conservative, and it doesn't mean that I always wait until I would have a 4 or 5 payback time or until the stock has a 22% return. It just means that that is the price I'm targeting, and if it ever got anywhere near that price, I would be putting a lot of money behind the company, because it means that I would be highly confident in making a substantial return in the future. And that price is basically the price where it says, just go into this stock all in. Put a lot of money into this stock. I will sometimes enter into a position earlier than it hits those prices, just so I can sort of get some money into the market and get a feel for it. But generally speaking, I won't complete a position until it reaches those very cheap prices, because of course, if we can wait for those very good opportunities, then we limit our downside dramatically. We take very little risk and our upside is massive. The potential for massive returns over the next 10 years is very substantial and very likely. And those are the types of investments that I like to make. So I hope you guys enjoyed my explanation of the payback time method by Phil Town. If you're interested in learning more about payback time, I'm sure there is a ton of videos on Phil Town's channel talking about this. So you can go see him explain it himself. He probably explains it a lot better than me. And you can also read his book, Payback Time, where he goes through and explains the payback time method and his other method, which is his margin of safety sort of calculation, intrinsic value calculation method. But if you did enjoy this video, please leave a like. And if you're new around here and you want to see more, then make sure you hit subscribe. But for now, guys, I'll see you in the next video.